It feels like 2021 all over again because meme stocks are rallying. Between last Friday, May 10th, and Tuesday, May 14th, the AMC stock is up more than 117%, and GameStop is up more than 200% in just a few days. Now, to put that in perspective, the average stock market return over the course of a year is around 10% historically. But if we want to compare apples to apples, GameStop is up 200% in just the last few days. But in the last meme stock rally, which happened in 2021, the GameStop stock rallied by around 2,000%. Now, if you hear that and say, oh, Jaspreet, does that mean that there's a lot of room for the GameStop stock to rally even more? Should I buy in? Stick with me until the end of this video. Now, between 2021, the last meme stock rally, and last week, GameStop has been falling. It fell from around $80 a share down to around $10 a share until last weekend, where Roaring Kitty posted a meme which essentially said it's game time. And ever since then, the meme stocks have been soaring again. So since then, traders have been making money, brokerages like Robinhood have been making money, but the people that have been losing money have been the short sellers, especially the hedge funds, because in just the last few days, hedge funds have lost more than $1 billion through this GameStop rally. Now, the reason why you want to understand this is because, well, last time, back in 2021 when this happened, Melvin Capital Management went bankrupt because of this rally. And I also don't want you to end up losing money by doing something that you don't understand what you're doing. So what I want to do in this video is go over 4 things. Number 1 is I want to go over why this rally is happening now in 2024. Number 2 is I want to go over why hedge funds hate what's going on. Number 3 is I want to go over who is making money. And number 4 is I want to talk about you and your risks, especially if you're thinking about getting involved, and why I'm not getting involved in this rally. Now, a couple points. You can see that this video is a little bit different production. It's because I'm recording this off my phone so I could create this in real time. And secondly, on May 21st at 8 p.m., I'm hosting a stock market investing workshop. So if you're thinking about investing your money for the long term, to be a long-term investor, whether you have a 401k, an IRA, or if you want to invest in individual companies, I'm going to be talking about my strategies in 2024 in this slowing economy during a period of high inflation. How you can invest your money and build wealth. It's completely free, and yes, it is live. So if you'd like to join me, I got the link for you down in the description below, because you have to register because we have a limited number of seats available. So number 1, why is this rally happening in 2024? And what I want you to understand here is the difference between short selling and trading, because what a lot of hedge funds have been doing is short selling this GameStop stock. What that means is you have a lot of these big institutions that are managing other people's money saying, we think that GameStop is going to go bankrupt, essentially. They think that GameStop is going to go down. And so instead of buying the stock, they're shorting it, meaning they make money when the stock falls. And this is where what happened back in 2021 was Roaring Kitty, this guy who became essentially a Reddit sensation, went onto Reddit, posted why he believes that this is a great opportunity to come in and buy, because if you can make the stock price go up, it could force the short sellers, these hedge funds, to lose a lot of money and give up their positions, and that could create huge profits for the traders. And that's what happened in 2021. Melvin Capital Management ended up going bankrupt because of that. And this is where essentially is kind of the same thing happening. Now, I want you to understand that this type of is called a short squeeze. It's not the first time that this has happened. In fact, one of the most famous short squeezes happened back in 2012. There was an investor, he's a billionaire, his name is Bill Ackman. He thought that Herbalife was going to go bankrupt. He said that it is a MLM scheme and it is going to go bankrupt, so he spent $1 billion shorting the Herbalife stock. Well, then you had this other investor named Carl Icahn, who also is a billionaire. And he saw this happening and he said, you know what? I don't think Herbalife is going to go bankrupt. So he came in and he started buying huge amounts of Herbalife stock. Now you got to remember, a stock price is determined by supply and demand. When you have more buyers than sellers, this can make the stock price go up. When you have more sellers than buyers, this can pull the stock price lower. Well, you have one investor, Bill Ackman, who's shorting the stock, who's trying to push the stock price lower. And then you have Carl Icahn saying, oh, no, you don't. And he comes in and starts buying the stock. Now, the reason why you want to understand this is because if you go out and you buy a stock, the most amount of money that you can lose is how much money you invest. Like if I invested $100 today in the GameStop stock, which I'm not doing, but if I did, the most money I can lose is $100. But if I was shorting that stock, there's no limit to how much money it can lose because the stock can go up to essentially infinity. I mean, there's no limit to how high a stock can go. And so if a stock keeps going higher, that means I can lose more money than what I put in. And that's what happened with Herbalife, where Bill Ackman saw that the stock price kept going up because there was now more buyers coming in than sellers, and that forced him to sell, and he lost over $1 billion on the deal. And Carl Icahn made $1 billion on that deal. So these types of short squeezes are not new. It's just new for retail traders, meaning it's new for people who are not big institutions, big banks, big hedge funds. And so that's where it's kind of new because it's built off of these online communities, which is why there's been a lot of controversy with Congress behind it. Now, I'm not saying it's a bad thing. It shouldn't be allowed. I'm saying it should be allowed, but it's not for me. And this is where right now, the reason why people have been buying it up is because they believe that they can do this type of short squeeze out these hedge funds, make them lose money, and make money in the process through this type of trading. Now, I'm not a trader. I don't believe in trading. I don't understand trading. To me, that's gambling, which is why I don't do it. But let me move on to number 2, why hedge funds hate this. Now, this one might seem a little bit obvious based off of the backstory that I already gave, but you have a lot of hedge funds that are losing money because especially of retail traders, meaning regular people who are now buying up GameStop and AMC. And that's why they don't like it. Let me give you a couple quotes from a couple different hedge funds who chimed in on this whole situation of the meme stocks going up. We had Oxford Algorithms. They're a UK-based hedge fund, and here's what they said. Quote, "There is no reason for the GameStop rally, as the results for the company are very poor." Number 2, this is from a hedge fund called Castle Management. And what they said is, GameStop investors are playing with fire. There are winners and there are losers. Don't be the last one to hold the bag. So why is it that hedge funds hate this? It's because if they're the ones that are shorting the stock, they don't want to be the ones that are losing money. And so just like with anything else, there are winners, there are losers, and hedge funds don't like losing money, which is why they don't like it when traders, especially retail traders, are causing the big hedge funds to lose money. Which brings me to point number 3, who is actually making money in this situation? Now, you might see this and say, well, people who've been buying GameStop are making money. But you got to remember, when it comes to an investment, you don't actually make money until you sell. So if you put in $1,000 in GameStop and it goes up to $2,000, you might feel like you made $1,000. But remember, you don't actually make money until you sell. And the reason why this is so important to remember is because back in 2021, when the GameStop stock rallied 2,000%, you had some people that were making a lot of money on paper, that they saw their stock rally and they made thousands, tens of thousands, hundreds of thousands, and even in some cases, millions of dollars. People kept the diamond hands. Remember that? Well, what happened was after the stock rallied to around $80 a share, it started falling. And that's why everybody said, don't sell. Hold on, it's going to go back up. But then it continued falling, and then came 2022, and continued falling, then came 2023, it continued falling, then came 2024, and it continued falling until, well, just a few days ago. So it fell from around $80 a share down to around $10 a share. So the people, if you held on and didn't sell, you saw a huge rise in your portfolio, but then you lost a huge chunk of that, if not all of that. In fact, some people ended up losing money if they didn't sell because they held on for too long. They bought it too high and then they continued to ride it down. So this is where what I want you to understand is, if you are in this game, understand that you don't actually make money until you sell. And the second person that's making money here that you got to remember is, of course, the brokerages, companies like Robinhood. Now, back in 2021, there was a big dilemma with Robinhood because they halted trading for retail traders. And that affected a lot of people because some people weren't able to make trades. They weren't able to make money because of their brokerage. Now, that hasn't happened. Hopefully that doesn't happen again this time. But the way that a lot of these, especially discount brokerages, make money is they make money every time somebody buys and sells a stock. So if you go onto Robinhood and you buy a stock of GameStop or you buy a share of AMC, Robinhood makes money. Now you might say, well, I'm not paying them anything. Well, the way that the system works is anytime Robinhood processes a transaction, they get paid. So they love it when people are trading stocks because that means they make more money. Now, not necessarily a bad thing. Just want you to understand that the brokerages are the ones that are winning because they're printing money. They're actually making money. Anytime somebody makes a trade, If you see a profit on paper, remember, you don't actually make money unless you sell and make a profit. Which brings me finally to point number 4. What are the risks associated with this, and why am I not getting involved with this whole situation? Now, I invest my money in the stock market, and I want you to understand that I have a strategy. And my strategy when I invest my money in the stock market is, number 1, I have a long-term investing strategy. Number 2, I don't short sell anything. And number 3 is I have a particular goal. Like when I invest in funds, every Wednesday I have a system where money is pulled out of my checking account and it's invested into my portfolio of funds. So I have some that give me dividends, some for value, some for emerging markets, some for innovation. This happens every Wednesday, whether the market's up or down, and these are going into funds that are my long-term portfolio. I'm paying attention to the fees here. I'm paying attention to the growth here. And this is something that's going to be happening whether the market's up or down. So this GameStop rally wouldn't affect this because that's my strategy here. My second strategy is what I like to call my active strategy, which is where I'm looking for individual companies to invest in. And when I'm looking for individual companies, I'm looking for a company that I believe is undervalued, that I can come in and buy and hold on to for the long term. That way it can make me a profit over the long term. That way I can see the growth of the company. This is trading. Trading is not investing. Trading is a way that people hope to make money in the short term, but you're taking on all the risk. I tried trading once when I was in college, and I realized that was not for me. Trading is not for me. I don't trade. So what I want you to understand is that if you are going to go out and trade, okay, but understand the risks associated with trading. You are more likely to lose money when you trade. Can you make more money a lot quicker? Sure, but you can also lose that money just as fast. For me, what I want is I want to be able to deploy my money, put it into an asset that I believe is good for the long term, hold on to the asset for the long term, and see this investment grow over time without having to worry about the day-to-day swings. What people are trying to do right now is make a lot of money very quickly. And some people will make a lot of money. A lot of people will lose everything and more. And this is where I want you to be a smart investor. If you are an investor, you don't got to worry about trading these meme stocks because it's a trade. Remember, you are an investor. An investor is somebody who's investing their money to grow their capital. Traders are people that are trying to make capital. Trader is an active game. It's like going to work. You're trying to get paid. You're trying to make money so you can have long-term investments. Investing is where you take the money you made and now you put this money to work. That way you can see long-term growth of the money that you created, the money that you already earned. So investing and trading are two completely different things. And you got to first understand, are you an investor or are you a trader? If you're a trader, well, I can't talk to you because that's not something that I do. Investing is what I do. This is not investing. This is trading. Some people will make a lot of money. Some people are going to buy a Lamborghini. Some people are going to buy some big homes. Some people are going to buy some cool stuff. Great. But a lot of people are going to lose a lot of money, especially the people that are coming in trading here with margin, meaning with leverage. And the most interesting thing about this, which I hadn't even mentioned yet, is back when the 2021 meme stock craze happened. You might remember that everyone said, oh, this is happening because there's that pandemic money out there. Everybody has the stimulus money. Everybody has the unemployment money. So they have money to dump into these meme stocks. But this is really interesting in 2024, which I want you to understand as an investor, especially as somebody who's paying attention to the economy, which is everybody's been talking about how Americans are running out of money, how people are going broke, how credit card debt has hit a record high, how consumer confidence is falling. I mean, this has been the most recent data on everything. Jobs have been getting hurt. Wage growth is getting hurt. Yet somehow, those same people, regular traders, have been able to find $1 billion and some and pour this money into meme stocks, into trading the stocks. Now, I get it. People are very passionate. Some people are doing this as a passion project because they're saying this is our way to essentially give the middle finger to Wall Street, to give the middle finger to institutions, to give the middle finger to hedge funds, which that's fine. If that's what you want to do, it's your money. You can do whatever you want with it. But what you got to understand is, are you a trader or are you an investor? If you are an investor, you got to ignore the hype. You got to ignore the noise. Now, you can also make a portfolio where you have a little piece of a portfolio that's more speculative. Like I have a piece of my investment portfolio that's speculative, where I invest in more speculative assets. But still, I don't trade because I know that I'm probably going to lose money. I'm going to buy too high and I'm going to sell too low because that's not the game that I'm in, and I have better uses of my time. For my speculative portfolio, I own things like startup investments that I've invested in because, well, most startups end up failing. And I also invest in some cryptocurrencies through my speculative part of my investments. I understand that the speculative piece of a portfolio can go down to zero, but it's a small piece of my portfolio. That's what the speculative part of my portfolio is. So now, as you are becoming a financially educated investor, remember your goals. What type of investor are you? What is your strategy? What type of investments are you making? And then when you see that shiny object, something that looks so cool, something that can promise you the riches very quickly, you got to be smart, because these types of shiny objects are going to appear in many different ways. Sometimes they're going to be meme stocks. Sometimes they're going to be hot cryptocurrencies. Sometimes it's going to be somebody on the internet selling you this amazing program that's going to promise you tens of thousands, millions of dollars very quickly with very little work. But you got to decide what's right for you. And at the end of the day, somebody's going to make money, but somebody else is going to pay the price. And while things can be attractive in the short term, what you want to understand is, what is your strategy? Because if you can stick with your strategy and you can ignore the shiny and exciting stuff in the short term, that's going to allow you to build a real wealth over the long term. And that's what I want you to do. I want you to build long-term wealth, because that's how you become actually wealthy. That's the proven way that most people will become wealthy in this country. It's by investing your money for the long term. It's not the most attractive thing to do. It's not the most appealing thing to do, especially when you have these huge rallies in these meme stocks. I mean, that's fine for some people, but you got to understand, what is your strategy, and stick to your strategy even when things get tough, because those emotions can make it very difficult to actually make money. And I'll give you another scenario of this, because if the stock market's crashing, what happens? People get emotional. They say, oh, now I'm going to change my strategy because the stock market's crashing, the economy's going to crash, everything's going to collapse. But the people that stick to their strategy, those are the people that can make money, because that creates an opportunity for you to come in and buy even more aggressively. But you got to be willing to stick to your strategy. That's why you got to know your strategy. You got to have the financial education. You got to know your goals, and then be willing to stick with them, even when things get tough, even when you see all these other attractive things happening, and you got to know, what is your goal? What is your risk? Because, well, trading is risky. It's for some people, it's not for me. And you got to know what's right for you. Now, a couple things. I want to remind you, May 21st, I have my stock market workshop. I would love to see you there if you are interested in being a stock market investor. If you're a trader, don't waste your time with this workshop. If you'd like to join me, I got the link for you down in the description. And secondly, I want to hear from you. What do you think about the GameStop rally? Is this something that you're involved with? If yes, then let me know down in the comments. If not, let me know down in the comments, but I want to hear why. Are you involved in this rally? If yes, let me know why. If not, let me know why as well. And with that, I'll see you in the next one.